Welcome to Tomorrow Unveiled, where the future isn't just predicted, it's explained. So here's what just happened. For the first time in nearly a decade, corporate clean energy buying fell globally, down 10%. And you'd think that's a disaster, right? Except it's actually not. Because buried inside that headline is something far more interesting. A complete reshaping of how the world's biggest companies are powering the future. Meta just signed a 6.6 gigawatt nuclear deal. Amazon's got nuclear deals of its own. Google and Microsoft are right there with them. Meanwhile, battery costs are plummeting, solar farms are pairing with storage at unprecedented scales, and countries from Tunisia to Japan are completely rewriting their renewable energy playbooks. This isn't a slowdown, it's a transformation. Today, we're breaking down what's really happening beneath these headlines, how corporate clean energy buying actually works, why the biggest players are making radical shifts, and what it all means for the future of power generation. Spoiler alert, it's wild. Let's start with the paradox, because it's the key to understanding everything else. In 2025, corporate clean energy procurement hit 5.9 gigawatts globally. That sounds huge, and it is. But it's actually a 10% drop from 2024's record 62 gigawatts. For nearly a decade, this number had only gone up. Companies were signing more renewable energy deals every single year. Then, it stopped. So what happened? Well, a few things converged at once. Power prices got expensive. Policy uncertainty spooked smaller players. Project costs rose. And here's the thing nobody talks about. The regulatory landscape started shifting in ways that made old-school renewable deals harder to justify. But here's where it gets really interesting. While overall volumes fell, the character of these deals completely transformed. The biggest tech companies, Meta, Amazon, Google, Microsoft, they accounted for 49% of all corporate clean energy deals. Nearly half. That's up from previous years. So the market didn't shrink evenly. It concentrated. The titans got bigger, everyone else got smaller. Meta and Amazon alone signed 20.4 gigawatts of deals, including 4.7 gigawatts of nuclear power. Think about that, just two companies, nearly a quarter of the entire global corporate clean energy market. The US market is still the largest, with 29.5 gigawatts of deals, a record actually. But here's the sobering part. The number of unique corporate buyers in the US dropped by 51% year over year. There are now just 33 unique corporate buyers in the entire United States. 33. That's a massive consolidation. What's really happening is a bifurcation. Large tech companies are moving into bigger, more complex deals. Nuclear power, hybrid solar plus battery systems, long-term contracts spanning decades. Smaller companies? They're struggling. They're grappling with higher costs, policy uncertainty, and the simple fact that they can't compete on scale. This is reshaping the entire renewable energy market, and we're only beginning to see the consequences. So why did Meta and Amazon suddenly decide they needed nuclear power? Because data centers are hungry, ravenously, insatiably hungry for electricity. AI training facilities, what Meta calls its Prometheus AI supercluster, these things consume power at scales we've never seen before. We're talking about buildings that need continuous, reliable, carbon-free electricity 24/7, 365 days a year. Solar works great, but it only generates power during the day. Wind is fantastic, but it's intermittent. Batteries help, but they're expensive and have duration limits. Nuclear? Nuclear runs all the time. It's carbon-free. It's dense. You can fit enormous amounts of power generation into relatively small physical footprints. For companies trying to train AI models while hitting net zero commitments, nuclear starts looking less like an exotic option and more like the only rational choice. Meta's nuclear deals are particularly telling. The company signed agreements with Oklo, Vistra, and TerraPower. Firms building next-generation nuclear plants and small modular reactors. These aren't your grandmother's nuclear plants. They're smaller, faster to build, safer, and designed specifically for distributed power needs. Meta's willing to invest billions because it understands something fundamental. If you want to power the AI economy while staying climate conscious, you need baseload power that doesn't emit carbon. Amazon went a similar direction, contracting nearly 4 gigawatts of nuclear alongside solar and wind. Google and Microsoft followed. And suddenly, the tech industry, which spent the last 15 years building renewable credentials with solar and wind PPAs, is reshaping itself around nuclear energy. But here's what makes this truly transformative. It's not just about their own power needs. By moving into nuclear in such a visible, committed way, these companies are sending a signal to the entire energy industry. They're saying, we need clean, firm power, and we're willing to pay for it. That signal is starting to reshape what gets built. And that leads us to the other side of the equation, the battery and storage explosion that's happening in parallel. While everyone was watching tech companies pivot to nuclear, something equally dramatic happened in battery storage. Costs plummeted. In 2025, the global benchmark cost for a 4-hour battery project fell 27% year over year. We're talking about dropping to $78 per megawatt hour, the lowest price point since anyone started tracking this data in 2009. That's not an incremental improvement. That's a fundamental shift in what's economically viable. Meanwhile, solar costs went up. Wind costs went up. Supply chain constraints, resource availability challenges, market reforms in China, all of it pushed traditional renewable costs higher. But batteries? They went the opposite direction. The cost curve is bending in a way that's reshaping the entire energy market. Here's why that matters. When batteries get cheap enough, suddenly co-located solar-plus-storage projects become the new standard. Developers added 87 gigawatts of combined solar and storage in 2025, delivering power at an average of $57 per megawatt hour. That's cheaper than most fossil fuel plants can compete with. This is driving a fundamental change in how corporate buyers think about clean energy deals. Instead of buying solar or wind separately and dealing with intermittency issues, companies are increasingly buying hybrid systems. Solar during the day, battery power at night. Smooth, reliable, increasingly affordable. The International Energy Agency has been tracking this explosion in battery technology and patents. Batteries now account for 40% of all energy-related patents globally. The innovation is happening at an unprecedented pace. Sodium-ion batteries are emerging as alternatives to lithium. Long-duration storage technologies are being developed for grid-scale applications. The entire storage ecosystem is evolving in real time. And here's the feedback loop. As battery costs fall, more hybrid projects get built. As more projects get built, manufacturing scales up further. As manufacturing scales up, costs fall even more. It's a virtuous cycle that's now embedded in the global energy transition. But scaling this up globally isn't simple. And that's where we run into some serious challenges. Here's the uncomfortable truth nobody wants to talk about. We're building a clean energy future that depends on materials we don't have secure access to. Batteries need lithium, cobalt, nickel. Solar panels need silicon, silver, rare earth elements. Wind turbines need rare earths for their magnets. And right now, the supply chains for these materials are, let's call them fragile, concentrated in a handful of countries, subject to geopolitical risk, vulnerable to export controls and supply shocks. The IEA has been sounding the alarm about this for years, and the situation is getting more acute, not less. China controls massive portions of critical mineral processing. Export controls are tightening. New supply sources are being developed, but slowly. Mining is environmentally intensive. Recycling infrastructure barely exists yet. Here's the specific worry. If we're going to build the clean energy infrastructure the world needs, and we're talking about tripling nuclear capacity, scaling solar and wind dramatically, deploying batteries at grid scale, we need a lot of these materials. And we don't have secure, diversified supplies. That's why the U.S. Department of Energy just awarded $19 million to 5 companies for research into nuclear fuel recycling. It sounds like a niche topic, but it's actually crucial. If you can recycle spent nuclear fuel, you reduce demand for freshly mined uranium. You close the loop. You make the entire system more resilient. Oklo, one of the firms Meta's betting on for nuclear power, received one of those awards because they're not just building small modular reactors. They're designing fuel recycling as part of the system from day one. This is the unglamorous side of the energy transition. It's not about solar panels or turbines or nuclear plants. It's about supply chains and recycling infrastructure and geopolitical resilience. But it's absolutely critical. You can't build a net zero future without solving these problems. And that brings us to what's happening in specific regions where countries are trying to do exactly that: build clean energy infrastructure from the ground up. Different parts of the world are approaching the clean energy transition in radically different ways. And it's worth paying attention because these regional experiments are becoming templates for the rest of the globe. Start with Tunisia, small country, North African nation, not typically on the radar for energy innovation. But in 2025, Tunisia cleared 2.3 gigawatts of renewable energy tenders and issued licenses for 287 megawatts of new renewable projects. That might not sound enormous in global terms, but for a country of about 12 million people, it's transformative. Tunisia is leaning hard into solar and wind because it's got abundant resources and growing energy demand. They're using a combination of international financing, private development, and government policy to accelerate the transition. The World Bank's backing some of these projects, recognizing that emerging markets need capital and expertise to build clean infrastructure. Tunisia is becoming a model for how African nations can develop renewable energy at scale. Then there's Japan, a completely different context. Japan's got limited land, high energy costs, and a population that's skeptical about nuclear after Fukushima. So how's Japan approaching clean energy? Corporate power purchase agreements, PPAs. Companies in Japan are increasingly signing long-term contracts with renewable energy developers. These aren't the same as the US model. They're being adapted to fit Japan's regulatory environment and business culture. Companies like PAG Renewables are signing 30-year PPAs. It's not flashy. Flashy, but it's systematic. It's building renewable capacity through corporate demand, not government mandates. The corporate PPA market in Japan is still small compared to the US, but it's growing. And it's showing how even countries with complex regulatory environments can unlock clean energy investment by giving corporate buyers the right tools. Now, flip to Ontario, Canada. Here's where things get really interesting because Ontario is building the first small modular reactor in the G7, the BWRX 300 from GE Vernova, going into Darlington. It's a big deal. SMRs are smaller than traditional nuclear plants. They can be built faster, they don't require as much cooling water, and they're designed for flexible deployment. Ontario's making a bet that SMRs are the future, not just for massive grid baseload, but for industrial applications, remote communities, and, you guessed it, data centers. The province is positioning itself as a hub for next-generation nuclear technology. It's a long-term play, but if it works, Ontario becomes a center for a technology that every jurisdiction on Earth is going to need. What's fascinating is how these three regions are actually complementary. Tunisia's scaling solar and wind in a developing market. Japan's building corporate demand for renewables through PPAs. Ontario's developing next-generation nuclear technology that can power data centers and industrial facilities. None of them is doing the same thing, but together, they're creating a blueprint for global clean energy development. Hey, real quick, if you're enjoying this breakdown of how the global energy system is actually shifting, do me a favor and hit that subscribe button and turn on notifications so you don't miss the next one. We're getting into some wild territory here, and you're going to want to stick around. Here's something that doesn't get enough attention in the Western clean energy conversation. China's emissions have been flat or declining for the last 21 months. That's not a small thing. China's the world's largest emitter by absolute volume. When China moves, the global emissions trajectory moves with it. China made a landmark pledge to cut its climate emissions. We're talking about explicit commitments to carbon peaking and carbon neutrality targets. The country's renewable energy capacity is now enormous. Solar installations are scaling at mind-boggling rates. Wind farms are proliferating. Hydroelectric dams are generating baseload power. But here's the thing, China's also still building coal plants. It's a complicated picture. The country is pursuing what you might call a both-and strategy, developing renewables aggressively while maintaining some fossil fuel capacity for reliability and industrial needs. What matters for our story is this: China's proving that it's possible to flatten emissions while maintaining economic growth. And it's doing it through massive renewable deployment and grid-scale battery storage. The technologies and approaches China's developing are influencing how other countries think about their own transitions. Moreover, China's dominance in manufacturing, solar panels, batteries, electric vehicles, renewable energy equipment, means that cost curves for clean energy technology are being set in Chinese factories. When China scales solar production, global solar costs fall. When China dominates battery manufacturing, battery prices plummet. This is why the IEA and other organizations are so focused on supply chain resilience. China's not going away. It's going to remain central to global clean energy development. The question is how other countries manage that reality. And here's where it connects back to everything else we've been discussing. As China continues to dominate renewable manufacturing, Western companies like Meta and Amazon are investing in next-generation nuclear technology. They're also investing in battery storage and solar infrastructure. But they're also increasingly concerned about supply chain risk. That's driving the recycling investments. That's driving the diversified approach to energy sourcing. The global clean energy transition isn't a simple story of renewables versus nuclear or developed markets versus emerging markets. It's a complex, interconnected system where China's manufacturing dominance, Western tech companies' power demands, emerging market renewable development, and next-generation nuclear technology are all feeding back on each other. Let's zoom out for a moment and talk about the fundamental purpose of all of this, because it's easy to get lost in the details of PPAs and battery costs and nuclear deals. The whole point is cutting emissions. Here's the basic math. When you generate electricity from solar or wind instead of coal or gas, you avoid greenhouse gas emissions. It's not complicated. A solar panel generates electricity for 25 to 30 years with zero operational emissions. A wind turbine does the same. Even accounting for the emissions from manufacturing and installing these technologies, the payback period is measured in months. After that, it's pure emissions reduction. Batteries accelerate this benefit by enabling higher renewable penetration. When you can store solar energy generated at midday and use it at night, you don't need to fire up a natural gas plant. That's additional emissions avoided. Nuclear works differently. Nuclear plants don't emit carbon during operation, but they do require uranium mining and enrichment processes that have carbon costs. Still, the life cycle emissions from nuclear are comparable to wind and much lower than fossil fuels. The advantage of nuclear is reliability and density, not necessarily the absolute lowest carbon footprint. What's happening right now, and this is crucial, is that renewables are becoming so cost competitive that they're displacing fossil fuels on economic grounds alone, not just environmental grounds. You don't need a carbon tax or a climate mandate. You just need companies to do the math. Solar plus storage is cheaper than building a new natural gas plant. That's the equation. The IEA tracks this obsessively. Global renewable electricity generation is expanding at unprecedented rates. In 2025, renewables accounted for over 30% of global electricity generation. By 2030, that number is projected to hit 50%. We're watching a fundamental transformation of the global electricity system happen in real time. And here's the feedback loop. As renewable penetration increases, grid operators have to get better at managing variable renewable energy. That drives investment in grid modernization, in forecasting technology, in demand response systems, in battery storage, which makes renewable integration easier, which drives more renewable deployment. So when we talk about renewables cutting emissions, we're not just talking about the direct carbon savings from each solar panel or wind turbine. We're talking about a systemic shift that's reshaping how electricity grids operate globally. But here's where things get genuinely difficult. Integrating massive amounts of variable renewable energy into existing electrical grids is hard, really hard. Traditional power plants, coal, gas, nuclear, they produce a steady, predictable stream of electricity. You can ramp them up or down based on demand. Renewables don't work that way. Solar produces power when the sun shines. Wind produces power when the wind blows. Neither of those things aligns neatly with electricity demand. So you need sophisticated systems to manage this. You need forecasting that can predict solar generation and wind speeds hours ahead. You need demand response systems that can shift loads to times when renewable generation is high. You need batteries to smooth out the variability. You need interconnected grids that can move power from areas with surplus generation to areas with deficits. This is called grid integration, and it's become one of the central challenges of the clean energy transition. It's not a problem you solve once and then move on. It's an ongoing engineering challenge that requires continuous innovation. Countries are approaching this differently. Denmark, which has massive wind penetration, has invested heavily in interconnections with neighboring countries and in flexible gas plants that can ramp up when wind is low. Germany is doing similar things with solar. The US is trying to upgrade transmission infrastructure, though it's moving frustratingly slowly. China's building ultra-high voltage transmission lines that can move power across vast distances. The good news? It's solvable. Grids with 50% or higher renewable penetration already exist. Denmark regularly sees days where wind generates more electricity than the country uses. South Australia has integrated massive amounts of solar and battery storage. It's not theoretical, it's happening. The challenge is scaling it globally and doing it cost-effectively. And that's where financing comes in, because none of this happens without capital. Let's talk about the money, because ultimately, the clean energy transition is a financing story. In 2025, global energy transition investment hit a record $2.3 trillion. That's trillion with a T. More capital is flowing into clean energy infrastructure than ever before. But here's the tricky part. The structure of that financing is shifting in ways that matter enormously. Traditional project finance for renewables has typically worked like this. A developer builds a solar farm or wind project, signs a long-term power purchase agreement with a buyer, and uses that PPA as collateral to borrow money from banks. The PPA provides revenue certainty. The bank provides capital. The project gets built. That model still exists, but it's becoming more complicated. Interest rates are higher than they were a few years ago. Policy uncertainty has increased risk premiums. Smaller developers are finding it harder to access capital. Meanwhile, large developers and corporate buyers are increasingly doing direct deals. Meta and Amazon signing contracts with nuclear developers, for example, sometimes providing capital directly. There's also a shift toward different deal structures. Hybrid deals combining solar, wind, and storage. Co-located projects where generation and storage are physically integrated. Long-duration storage projects that can discharge power for 8, 10, 12 hours or more. These are more complex to finance because the revenue models are newer and less proven. And then there's the emerging market challenge. Developing countries have massive renewable resources but limited access to capital. A solar farm in Tunisia might be economically viable, but if the developer can't secure financing, it doesn't get built. That's why institutions like the World Bank and regional development banks are increasingly involved in renewable financing. They're not just funding projects, they're de-risking them, providing guarantees and concessional financing that makes projects bankable. The cost of capital varies dramatically by region. Developers in the US or Europe can borrow at relatively low rates. Developers in emerging markets face much higher costs. That's a drag on global deployment. Bridging that gap is one of the central challenges for the next phase of the transition. What we're seeing in 2026 is a maturation of the renewable finance market. It's becoming more sophisticated, more complex, more attuned to different regional contexts. The days of simple, one-size-fits-all project finance are ending. The future is more nuanced, and that brings us to what all of this means. The bigger picture of where we are in the transition and what comes next. So let's step back and think about what's actually happening here. We started with a paradox. Corporate clean energy buying fell in 2025, but the market fundamentally transformed. That's not a contradiction. It's a feature of this moment in the transition. The easy phase of the clean energy transition, deploying solar and wind in favorable markets, signing PPAs with willing corporate buyers, that phase is ending. What's emerging is more complex. It requires bigger capital commitments, longer time horizons, more sophisticated deal structures, and willingness to invest in frontier technologies like nuclear and long-duration storage. Big tech companies are leading this because they have the capital, the risk tolerance, and the strategic motivation. Their data centers need clean, reliable power. They're willing to invest billions to secure it. And in doing so, they're reshaping the entire energy market. They're signaling that nuclear is viable. They're driving battery innovation and cost reductions. They're proving that hybrid renewable-plus-storage systems work at scale. Meanwhile, emerging markets like Tunisia are building renewable capacity with international support. Japan is developing corporate PPA frameworks. Ontario is betting on SMRs. China is flattening emissions while maintaining growth. Globally, the transition is accelerating, not decelerating. Yes, there are real challenges. Supply chains are fragile. Grid integration is hard. Financing is complicated. Policy uncertainty persists. But the momentum is real. The cost curves are bending the right direction. The technology is proven. The capital is available. What's happening right now is the transition moving from the early adopter phase into the scaling phase. That's messy. It's complicated. It involves consolidation and disruption, but it's also accelerating. We're not slowing down. We're speeding up, just not in ways that fit neat headlines. The corporate clean energy market fell in 2025, but everything underneath that headline, the nuclear deals, the battery breakthroughs, the regional initiatives, the financing innovation, the supply chain work, all of it points toward a clean energy future that's becoming increasingly real, increasingly tangible, and increasingly inevitable. That's the story beneath the story, and it's just getting started.